Hi, Brianna.
Hello.
All right. Is this my marine biologist?
Yes,
You never saw that show Seinfeld, huh?
I do, but I can't recall if George was the crazy hair one or the bald hair one.
He was the bald guy, the crazy, not the crazy guy, but the bald guy who was always pretending to be something. And somehow this girl got the impression that he was a marine, a marine biologist.
Oh,
And he thought she would never find out until they took a walk on the beach and it was a whale that was stranded. And someone yelled, "Is there a marine biologist here?"
no.
Hi,
I was thinking.
Christina. I'm
I
sorry,
was.
Brad.
I was thinking more of the crazy haired one because my brain frazzled and I'm just like, oh, that's what.
He was part of that subplot as well, but George was the ersatz marine biologist. I see we have Christina. Hi, Christina.
Hi, how's it going?
Good, good. And we have Ian. Okay, we're starting to get a few people here. We'll get going in a moment here. We've got 4 people. You think we'll get all 36? I doubt it. Ian, do you want to show your face while we're on the class here, or are you going to remain in the dark? Same thing. Michelle, okay. Michelle, let's just wait perhaps another minute or so. What we're going to go through is we're going to go through chapter 2, which is, I think, if you master chapter 2 in terms of the basics, what a big shortcut that is going forward. Hi, Ian. How you doing? Good to see you. So we'll go through chapter 2, which should not take terribly long. And then depending on the time, I would like to get into chapter 3, which continues the same stream of 2. There are 2 that really should be taught together, okay? All right, it's 12:01. We have 5 people here. We had a few more the last time. So I am going to begin. Is that okay with everybody?
Yeah.
Okay. Hi, Michelle. How you doing? Good to see you. All right, hold on here. This time I will have no problem bringing over the PowerPoint. Do you all see the PowerPoint?
Yes.
Yes, I get a yes. Okay. Slideshow custom. Here we go. What we're going to do in chapter 2 is go over a couple of terms, and then we're going to do a few transactions without knowing about the world of debits and credits. We're just going to get more comfortable with the accounting equation, how it has to remain in balance at all times. And then after an introduction to the debits and credits, we're going to repeat those same transactions as they would be done in any accounting software package, okay? So let's start off with what we have here, understanding the business. What activities causes changes in our balance sheet or our financial statements? How do activities affect balances? How do companies keep track? That's what we're going to talk about here. This grid here, as far as I'm concerned, we can skip this, okay? This is more gibberish, okay? Back to the accounting equation, and we are now experts in this. We know that assets equal liabilities plus stockholders' equity. That equation must always be in balance, and if it ever goes out of balance, you got a real problem. I don't think it's possible for the accounting equation to go out of balance in the year 2021, since everything is done with a computer program, and no computer program is going to let you post an unbalanced transaction. Back in the days of HECK, when I had to do this in pencil for years, you could go out of balance due to you making a mistake, and that was a problem. Assets, these are things that are good to own by the company, cash, Liabilities are monies we owe to somebody. We borrowed money or we bought something on credit. And the equity is the net worth of the business on paper. Assets equal liabilities plus equity. Assets minus liabilities equals the true net book value of the company. And we saw this grid, I believe, in chapter 1, where they gave some descriptions of these things. Cash, we know what that is, short-term investments. Ownership of other companies, stocks and bonds. Got happy fingers, I'm sorry, I keep hitting that button. Accounts receivable. Monies owed to us by our customers. Accounts receivable, monies owed to us by our customers. And then they're talking about prepaid supplies and prepaid expenses, which we're going to go into in another chapter and a half or so. And then you've got 2 categories here. Current assets. That's very important. Current assets. Notice which ones are labeled as current. Cash, short-term investments. That means stock or a bond, perhaps you bought in another company. Accounts receivable, what people owe you at that point, your customers and your supplies, and prepaid expenses. A current asset is defined as those resources you're going to chew up in a year, basically, in an accounting cycle, a year. So any asset that you're going to turn over within 1 year is a current asset. Those are the ones you're using to make profits continually. The long-term assets or fixed assets or non-current assets are your big ticket items, your buildings, your big pieces of equipment, cars, things like that. If accounts receivable represents monies owed to us by customers, accounts payable is the reciprocal. That's what we owe to the people who provide us with products and services. And we'll get into the accrueds a bit later. What causes activity? We looked at this grid in a different format before. We're in this course here, we're strictly external, huh? Everything we're doing is based on GAAP, generally accepted accounting principles, and they are meant for use by outside parties as well as the company. These statements are important to bankers, to lenders, possible investors, employees, the families of employees want to know how their spouse's business is doing. What we're going to learn in a little bit in this first 20 minutes or so is that every one of those accounts, cash is an account, equipment is an account, inventory, and notes payable. Each one of those comprises what's called the chart of accounts. The chart of accounts. These are the items, these are the activities that each company chooses to segregate in a particular folder, if you will, to keep track of them. So you would have cash would certainly be one. Inventory. Those are your folders. Let's take a look at this briefly. Typical account titles. Just some tips here. When you see the word receivable, we know that's an asset. Receivables are assets. The prepaids are assets. How about this one? Prepaid expenses is always an asset, huh? What I'm going to tell you about that, and this is more for a chapter 4 type thing. A prepaid expense would be perhaps an insurance policy you bought in December that insures you for the following 12 months, the next year. At the time you bought the policy, you had no coverage. That policy doesn't kick in until January 1st. If your business burned down December 31st, you're out of luck. So at that point, that is not an expense, that's an asset. That thing has value, but the value doesn't kick in until next year. So at the start of the following year, you're going to record that portion of the prepaid amount as an expense and keep reducing that asset. And I'm probably getting a little ahead of myself here, but that'll be a big part of what's coming up. Let's talk about unearned revenue. Unearned revenue. This is cash that has been received, even though the company has done nothing to earn it yet. And I'm the big sports fan, and I always use, season tickets. You send a check today to the Dodgers for the upcoming baseball season. When they get that money, they're going to debit cash and they're going to credit a liability account. Unearned revenue is a liability, unearned revenue. And then when they start playing baseball, it's a 6-month season. They're going to take 1/6 of this amount and move it into revenue and reduce the liability. It's a liability in that they don't owe us money. They owe us baseball. Stockholders' equity, contributed capital, retained earnings. Those are just 2 of maybe 7 or 8 different categories we're going to learn in this course. Contributed capital, somebody put their own money in the business, or more likely in this course, they raise stock with a stock issue. Revenues are the different kinds of fees and sales. Cost of goods sold. Cost of goods sold. That is the outlier. That is the expense to record at the time of the sale. Cost of goods sold is simply the amount you paid for the item you sold. You sold a diamond ring for $10,000. That's your cost of goods sold. The cost went up because you don't have that ring anymore. And the inventory went down by the same amount, but you sold it for a lot more than that 10,000. So your sale was maybe 50,000. Principal. I guess you can never look at the accounting equation too much, huh? Every transaction affects at least 2 accounts. 2 accounts. You can't have a transaction with just one debit, one account. 2. That's why it's called double entry bookkeeping, double entry accounting. And each transaction is going to affect an asset or liability or stockholders' equity, or it could be 2 assets. You could have a balance entry, just 2 assets. One asset went up, one asset went down. Same thing with liabilities and equity. So we're talking about balancing the accounting equation. They're trying to get you to think in terms of these steps. What was received and what was given? Identify the accounts by title. We saw that list of the assets, the cash, the accounts receivable. See if you can figure out what accounts are affected. If you know that, you're halfway home. And then we need to understand which one is an asset, liability, or equity account. Is this account going up? Is this one going down? And are we in balance? So we're going to spend a few minutes now looking at some transactions without regard to the use of the words debits or credits or general ledger yet. That's coming shortly today. What we're doing here is we're just going to show you how the accounting equation remains in balance after a transaction, okay? So this company did not exist until Chipotle issued 10,000 shares of common stock, receiving $62,300 in cash, okay? And I have to move this over. I'm blocked out here a little bit. And what they're telling you in tiny little words here is that it was 10,000 shares at 1 cent per share par value of the stock. We have a whole chapter on common stock. But when you see that line, common stock, in your financial statements, it's always going to be the shares times the par value. The par value has nothing to do with the value of the stock. It's a meaningless, nominal, required number that a company must put on the stock certificate. Has nothing to do with the market value. So what happened here? Well, the par value was a penny, but look what the world kicked in. They got $62,300 from the public. So they clearly knew that the 1 cent had nothing to do with the market value. So here, cash went up. They issued these 10,000 shares, and they brought in $62,300. The public valued the stock at $6.23 a share. Common stock is always a very low number in that it's a multiple of the shares times the par value. The difference is called additional paid in capital, or paid in capital in excess of par, a couple of different terms for it, okay? So now you have three elements in your stockholders' equity: common stock, additional paid in capital, retained earnings. There's no retained earnings yet. The company's not done anything. So is the equation in balance? Yes, it is. 62.3 equals 100 plus 62.2. Okay. Get this out of my way here. Let's take a look at the next one. Hey, they borrowed money. Chipotle borrowed money. So what accounts do you think this would affect? Well, money is cash, huh? So we know cash is going to go up, but this is money they need to repay. So it's also a liability. That's what a liability is, a debt, right? An IOU, a promise to pay. They borrowed this money. Cash goes up by 2,000. Notes payable goes up by the same 2,000. Right now, we got the cash went up, but so did the debt. We have to repay that $2,000 sometime in the future with interest. And our accounting equation remains in balance. Let's see what else is going on now. Wow. Chipotle went out and bought ovens, counters, refrigerators, and other equipment costing $63,100. That was the bill they received from the supplier. They bought all this stuff from Sears or somebody, huh? So we know that the property and equipment cost them $63,100. So that is going to go up. Up. Well, let's see the particulars. They had to pay cash $55,100. So the cash goes down by $55,100. And they had to they had to finance this $8,000. So that's another note. Notice it's notes payable, not accounts payable. Accounts payable are the debts that you owe your suppliers, the people who sell you your inventory and your utilities and insurance, things like that. Borrowing situation, which is what this is a note payable. Note payable. Analyzing a few more, huh? Chipotle paid back some of the money they borrowed. Ignore interest. Wow, I wish somebody would loan me money with no interest, huh? Although interest rates are so low, actually interest rates are so low, it's close to zero, but I digress. Chipotle paid $400 to the local bank on the amount borrowed. So what happened here? The bank loan went down. We don't owe the $2,000 anymore. We paid $400 down. Cash goes down $400. Liabilities go down. So here's an example: double entry accounting. An asset goes down, liability goes down. They purchase stock in another company. Isn't that great? A company has so much money left over, they're able to buy stock in another company, okay? And some of the investment they made was long-term and some is short-term. And we just heard about something called current assets and non-current assets. Well, long-term assets are $20,900. This could have been a bond or something. Could have been a bond. It could have been stock that they pledge not to sell for a while. And the balance is short-term, like a CD, perhaps, a short-term CD, certificate of deposit. So let's see what we have here. All right. They paid $60,400 in cash. They paid $60,400 in cash, and $20,900 of it is in the form of a long-term investment, and the balance difference between these two numbers is the short-term investment part. So here's an example where all three parts of the transaction were assets. We exchanged $60,400 for two investments that we hope will grow over $60,400. We are still in balance. I like that cash balance, huh? Cash is down to minus 51,600. These guys better start selling something. Chipotle does not pay dividends, but it reinvests profits. However, we're going to show you what a dividend looks like, huh? A dividend, you own common stock or preferred stock, and you may receive a dividend from the company. It's a payment that they reward you with for holding the stock. And some companies are known for never missing a stock payment over 100 years. Other companies don't pay dividends at all because they plow everything back in the company to grow it and really boost up the price of the common stock. So let's see here. They're going to pay $3,000 in dividends declared. Once the company announces that word declared, dividends declared, is a very specific accounting term. When the board of directors announces that they're going to pay a dividend, that becomes a liability. Companies never have to pay a dividend, not even to the preferred shareholders who bought the preferred shares only to collect the dividend. Companies never have to until they declare. So let's see here. We are going to pay this later. So now we have another liability account, dividends payable. That's money that you and I are going to receive because we own some Chipotle stock here. So 3,000 liability went up. Now take a look over here to the lower right. Look what went down. Your retained earnings went down. That means that your equity went down because any dividend declared, eventually paid, reduces the net value of the company. That's what a dividend is. You're giving away partial ownership of the company, or let me say it this way a little more clearly. You're reducing the value of your company by giving away $3,000 to people who own your share in the stock market. Okay, so we just went through some basic transactions here. And notice I was using words like up and down, higher, low, increase, decrease. Now we're going to start, hopefully, getting you going on the fast track here with the words debit and credit, general ledger, things like that, huh? So the accounting cycle, basically, it begins the first second of the new month. And throughout the month, you're analyzing transactions. Some are big analyses and some are not. Simple ones would be, okay, we got the payroll this week. Let's record all the timesheets for everybody. Add those numbers up. Do they make sense? Last week's payroll was $100,000. This week's payroll, you're trying to tell me is $1 million? Hey, go back and find your mistake, that type of thing. It could be as simple as opening up the mail and there's a bill for some insurance expense or advertising. So you're doing that every day and you're recording this information in the form of journal entries. At least in this course is how we're doing them, via journal entries. Journal entry is the mechanism for updating the general ledger. And the general ledger is the books of the company. You've heard that expression, the books, they're cooking the books. I want to see the company's books. The general ledger is one folder for every account showing you the beginning balance, the running balance, and the activity. So during the month, we're analyzing, recording, posting. The end of the month, we're going to prepare what's called a trial balance. And then there will be two kinds of entries called adjusting journal entries. And we can prepare the statements and then close. So let's see what we have here. General journal. Journal entries is another word for that, okay? Journal entries. The general ledger. That is a double T account. You're seeing T accounts now for the first time, I believe, a T account. A T account is simply a piece of scrap paper that you can use to organize data. You could be working for a public accounting firm for 30 years and have all the credentials in the world. And invariably, you'll be sitting down and you find yourself writing some T accounts down to help you better understand the transaction and what you're trying to do. T account and the general ledger, which is really just a double T account. Say hello to the words debit and credit. And for those of you who did not take Accounting 110, this is where you're going to have to fight a little bit to catch up, okay? Debit and credit. Let's understand what the words mean. They mean left and right. That's all it means, left, right. Debit's on the left, credit's on the right, okay? Debit and credit means left or right, okay? A debit and a credit have no moral value, one or the other. One's not good, one's not bad. They are the rules for recording activity, okay? Now, here's what we want to talk about. The left side is the debit side, the right side is the credit. Assets are increased with a debit. Assets are increased with a debit. Since assets equal liabilities plus equity, that means that liabilities are increased with a credit, and all of the, and all of the equity accounts go up with a credit as well. Common stock up with a credit, retained earnings up with a credit, liabilities up with a credit, assets up with a debit. You see where it says assets debit balance? That's known as the normal balance of the account. The normal balance of the account is the side, left or right, which increases the balance. So if you have no money in cash to begin and someone pays you $100, you would debit the asset called cash, okay? So this is just a way of getting started. If you find yourself struggling with this, you know, I can help you. There's different acronyms, and I'll go over a couple different ways to kind of memorize this. When you're doing your homework, you know, maybe you have this right in front of you, this grid here. And they're going to show you different ways to memorize. And I hate to use the word memorize, but that's pretty much what it is till you get the fluency going. Assets have normal debit balances. Normal debit balances. Cash is an asset. So at the end of the month, when you run your reports, if you see that the balance in cash was a credit, you have a problem. There's something wrong there. Something has been entered incorrectly and you need to fix it. Could be somebody stole money and you're just finding out about it now. Or you could do what a lot of businesses do, and I was guilty of it for years and years. Maybe you're floating a couple checks, which you're really not supposed to do. You know, write a check on the last day of the month that drives your cash account into negative, knowing that you got monies coming in. Liabilities and equity, credit balances, credit balances. So now what we're going to do, we are going to look at the same transactions that we just did in the horizontal plus minus format, okay? And we're going to do something. We are going to update the general ledger via journal entries. Journal entry. When you go into your computer system, you're sitting there and you've got all this information. You're looking at a payroll report. And you're saying, okay, let's see, salaries and wages were 100,000 for this department, 50,000 for this. And you're putting all this information in. Then you go to the next journal entry. Oh, here's the electric bill. I got to put that in. You go to the next journal entry, etc. Nothing happens until you hit the post button, until you hit post. And then these journal entries will find themselves detailed in the general ledger. At that point, it's a permanent record, never to be removed. If you make a mistake, the only thing you can do is reverse the original entry and put in the proper information. So what does a journal entry look like? Well, it's going to have a date. They're using A, but it'll have a date probably. It could also have an A in some kind of reference to. Here, what happened? This is the transaction where Chipotle issued stock, that those 10,000 shares at a penny a piece. You debit cash because cash is increased with a debit. You credit common stock for the multiple of the par value, and you credit the difference into additional paid-in capital. That's what your journal entry looks like. You should also, I'm not going to force you guys to do it, but if we were in the classroom, you would have to give me an explanation for every journal entry. And it could be something, just a few words, something very simple. And it can always begin with the words "to record." You could give me your explanation on this one: to record stock issue. Now, why do I say that's important? Well, two reasons. One reason is if you don't put in a brief explanation down, when the auditors come in 9 months later and they point to something in the general ledger and say, "What's this number?" You're not going to remember necessarily until you look at the entry and see the explanation. So it provides a trail, if you will, a track. But you know what's another important reason for that? If you can't write a brief snippet of an explanation you're finding difficult to put in words, there's a very good chance what you're trying to do is wrong. And that can be very helpful at times, okay? So let's see what happened here. Look what happened the moment we posted this information. Okay, here is our journal entry on top. Here's our journal entry. We debited cash to increase it, and we credited these two stockholders' equity accounts to increase those as well. That's the general journal, your journal entries. Look at your general ledger now. You're seeing the general ledger for the first time. Look where that $62,300 went. It went from the journal entry into your general ledger. You now have a debit balance in your general ledger of $62,300, or at least an incremental difference of $62,300. And cash in this case went from $401,000 to $463,000. Same thing with the $100 for common stock. You had $300 before, it's now gone up, and ditto with the additional paid-in capitals. So what you see here is what happens when you post the journal entry. Okay. Anybody questions? Anybody want to jump in? I guess not. The T account. After journal entries are prepared, the accountants post the dollars to each account affected by the transaction. It says T account. And I told you T account is pretty much, scrap paper. And it is. But what they're trying to do here is emphasize that the general ledger is simply a fancy looking T account. So we can think of these as the general ledger. Cash, 401.2 to begin, plus that 62.3. Here it is right here. This is your general ledger. Does that look like a T account? Debit, credit. There's your debit side. There's your T account right there. So the T account mimics the general ledger. So after all journal entries are prepared, you hit the button post, and all of the ledger accounts that you journalized are going to be updated. Okay. And they're giving you a couple tips here. Let's see what this is. Start with the beginning, use the same references in the journal. Yeah, that's an important thing you're going to learn pretty quickly. You see that A there? A, and then you see the same A for the 100. That's a way to keep track of that journal entry. That was journal entry A, if you will. You're not recording it as A. Let me just see something here real quick. Quick. See, journal entry A. Journal entry A. So when we come down here into our general ledger, we should see that A there somewhere. In the case of the ledger, it might be a date, A, and then you're able to see what the heck was going on. And then they're suggesting you draw a line here, put the ending balance. One thing students do that's not right, and let's not get caught right here, you're never going to put a negative number here, right? By definition, all these numbers are going to be positive integers because you're either increasing the debit side or you're increasing or decreasing the credit side. So here we go. I don't know about you, but I'm getting sick of looking at this one entry again, huh? Chipotle, it did this transaction again. So, journal entry, cash went up. So did the two other elements. Classic journal entry posting. Debits equal credits. We're in balance with the transaction and we're in balance with the overall. Remember that money they borrowed before? We were saying, well, the liability went up, cash went up. We don't say that anymore, do we? Cash is debited, notes payable are credited. They both increase with the proper side of the T account. So let's see what we have here. Cash went up 2,000. So did notes payable. Okay. The balance is growing. Wow, we're really skipping ahead, huh? So there were a whole bunch of transactions that were apparently done. Okay. Let's take a look what we have here. After analyzing all transactions A through F, and you would have gotten the F in a handout. It's in your book though. After analyzing all transactions A through F, the balance in our T accounts would look as follows. Well, cash had a beginning balance of 401,200. And then we had cash infusions of 62,003 and 2 when we borrowed the money, 55,100. Remember, we bought the equipment. 55,100, we bought the equipment. $400, we paid back the note. And the 60,400, what was that for? We did something. We spent a lot of money there. 60,400. So I'm looking for the E. There we go.
Like investments.
Excellent. Thank you. Thank you, Ian. Good. You follow the E. We spent this money for a short-term investment and the long-term investment. Okay. And what they're showing you here is you maybe double line. I mean, you're going to be doing this on a computer screen. You don't have to worry about it. So the balance in cash at the end of the month is $349,600. Very simple. You add the debit column, you add the credit column, and the high man wins, right? Cash should have a debit balance. Debit balance here for these assets, these 4 assets. Here we expect a credit balance. They had a starting note balance of 200. Wow, they owed 223,600,000 to begin the month. And then they borrowed 2,000 more. They borrowed 8,000 more, and they paid back 400. Dividends payable. That's a liability. And notice everything is in the correct side. Your assets are on the left, meaning that they go up with a debit, and the normal balance of the payables and the equity all have to be credits. Now we're done for the month, okay? We're done for the month. You do your homework in this chapter and study, and you should have a pretty good understanding of the journal entries and the T accounts and how they impact the general ledger. So now it's the end of the month, or in this case, the first quarter. And we're going to print a report called the trial balance. And let me change the word report to worksheet. The trial balance, again, is not anything we're going to hand out to the public. Nobody would be interested in it. The only thing the trial balance does for us, ladies and gentlemen, is that it verifies that the debits equal the credits, okay? So now the month is ended, and they're saying debit 349.6, 94.5. Where did they get these numbers? They got them from the ending balances in your general ledger. 349.6, 94.5, 94.5. There's 859, and these are other ones we didn't touch. So let's see what we have here. We have a trial balance that adds up properly, 1,497,000, 1,497,200. Okay. Now we're ready to start what's called the closing process. At this point here, you're going to learn that by definition, this trial balance is wrong. It's definitely wrong in that it's incomplete, because there are certain entries that can only be prepared after the month is ended, called adjusting journal entries, and we'll get into that. But I think for purposes of this chapter, we're pretending that this is a good final report, okay? Classified balance sheet. When we say classified balance sheet, it means that we're showing the current assets separate from the non-current assets. Same thing with the current liabilities. Everything is based on a year. A current asset is one to be used within a year. Cash. You're not going to go a whole year without spending money. Accounts receivable. You're going to be selling things to increase it and collecting cash to reduce it. Same thing with liabilities. And here they're showing the balance sheet as of the end of the quarter. This was our beginning number. You remember the 401,200 in cash and the 55 in short term? 401.55. Those are your beginning. Those were the beginning balances this period, which by definition makes them the ending balances of the last period. Sometimes that's a little bit of a mental block. The student will be working, maybe get a little nervous and say, gee, I know the 349,600 is the ending balance for March 31st, but what's the beginning for April 1st? Well, it'll be the same number, okay? So we can take a look at this and make a few judgments. They spent some cash. They took on a little bit more debt, just a little bit, things like that. Let's not worry about the international perspective. International, we don't care. They're showing us a ratio. In about a week or two, you're going to get an FSA assignment where I'm going to assign two companies to you, two well-known companies in the same industry, and you're going to prepare what's called a financial statement analysis of those two companies. And it will include various ratios like this. This is a good one to show you. You're seeing this for the first time. The current ratio, it's called. The current ratio. It's simply the current assets divided by the current liabilities. Current assets divided by current liabilities. Investors, this is one of the first things investors look at real quick. Current ratio. So this company had $501,000 worth of assets against $157,500 of liabilities. So this tells the world that Chipotle has $3.18 of current assets. And when we say current assets, we mean assets that get turned into cash quickly. So they have $3.18 worth of assets, which they can use to pay off all of this debt. Another way to say it is, if Chipotle paid all of this debt down at one shot, they'd still have $2.18 left over. So the current ratio is a high level liquidity, well over 1, and the ratios varied slightly. The current ratio, what that does is demonstrate how solvent you are. Technically, if these numbers were reversed and the liabilities exceeded the assets, technically it means they're not in a position to pay their current debts. And that's probably a bad sign, huh? Cash flows, operating, investing, financing. That's all you need to know about that right now, huh? End of chapter 2. I am now going to take us a little more into chapter 3, okay? This is an accelerated class. You have chosen to accelerate, huh? So let me get in here and bring up the next chapter. Can you see chapter 3 now? Do you see that, Ian?
We're on end of chapter 2.
Okay, hold on. Chapter 3 now?
Yes.
Okay. Let me do my Sheldon Cooper thing. What I'd like to do is go through this chapter a little more quickly than I did chapter 2. I'm getting a little bit ahead of us here, but get chapter 2 under your belts, because that is so crucial. And here's where we're going to go with this. How do business activities affect the income statement? In chapter 2, we didn't touch the income statement at all. Everything was on the balance sheet. So let's do a few transactions with the income statement. And they're looking at the operating cycle. Operating cycle, huh? I guess it begins by buying your inventory items and things, and you collect cash from customers, and then you pay for things, the cycle, the endless cycle. Time period. These are accounting principles, generally accepted accounting principles. The time period principle, what it means is you should be able to look at a business and split it into a finite period of time for analytical purposes, typically a month. Most companies, they go through this every month. Time period. The recognition issue is important. We're going to learn about that in a moment. When do we record these effects? And then what amounts should be recognized? What is on the income statement? Revenues, expenses, gains and losses. Revenues minus expenses equal net operating income. Operating income. That's the money that the business earned from selling tacos and salads. Net operating income plus gains or losses from peripheral activities gives you net income. Gains or losses have nothing to do with operating. They occur from collecting interest income, perhaps, or paying interest income. Your income taxes are not operating. So for the first time, we're looking at an income statement, right? Chipotle, income statement. Let's see what we have here, huh? Operating activities. Operating activities. Selling of food. Obviously, there is the sales revenue number, and it cost them $738,700 in supplies, food, straws, napkins, takeout containers. They have to pay their employees. They have all kinds of other expenses which they are not detailing. And they have depreciation expense, which you'll learn about. The wear and tear on their equipment. So they had sales of $2,269,000, operating expenses of $1,913, and that gave them a net income of $356. 356 divided by 2,269. If you took that net income and you divided it by the sales, that would be about 1/7, I guess. So they earned about 14%. This company, Chipotle, earned roughly 14 cents for every dollar they sold. But then there were other items that had nothing to do with preparing food, nothing to do with marketing their product or paying people. And that was these peripheral things. Investment income. You buy stock in another company, that has nothing to do with making food. Interest expense, maybe a gain on disposal of assets, although that rule has changed. Okay. So their net income was 215,000. Net income, not operating. Operating, they did very well, but they had to pay their taxes too. So their earnings per share were $6.89. They're telling you here that there were 31 million shares outstanding, and this number here is actually 215 million. So if you own stock in Chipotle's and you see that they earned $6.89 per share, you might say to yourself, well, I would like them to give me perhaps $2 of that in the form of a dividend. They may or they may not. Or you may say instead, I don't want a dividend. Good God, don't give me a dividend. Take that $6.89 and throw it back into the business and grow more stores. Operating expenses. Any expenditure? The difference between an expense and an expenditure. An expenditure is an actual flow of money. Expenditure, that's actually you paid somebody. Expenses are outflows, and expense is often recorded with no cash at all because you're going to pay later. And this is what we're going to talk about. Restaurant operating expenses. Well, I guess these look like normal ones to me, huh? International. We don't care about the international. Cash basis accounting. We are not going to talk about it. We're not going to teach it. And the only thing that I'm going to say about cash basis accounting is, first of all, it's not GAAP. And if a company is seriously trying to run their business on a cash basis accounting, they're going to cash basis themselves out of business because they're going to have no idea how the business is truly operating. And if you want to talk to me about it sometime, if you want to learn more about it, that's okay. The only cash businesses are real tiny ones that do the same thing over and over, little small mom and pop shop. Cash basis statements, you'll never be able to borrow money with them. You'll never be able to attract investors. You might not even be able to hire employees if they realize that your financial statements are not going to be right. Assets, liabilities should be recognized when the transaction occurs. Assets, liabilities, revenue, expenses should be updated when the transaction that causes them occurs, not necessarily when cash is paid or received. So important, so important. And we're going to look at some examples of that, and then we'll get us out of here in a brief while. GAAP, generally accepted accounting principles, and this is what accrual accounting is all about. Accrual accounting. The word accrual represents a temporary payable. What it means is when the activity occurs, that's when you record that expense. The end of the month comes, for example, and you're looking at your trial balance and you don't have any electricity. Well, you know you used electricity. You also know you're not going to get the electric bill for 3 more weeks. Bill Gates is not going to tell the world, well, Microsoft can't announce its earnings till we get the electric bill from San Marino. You will record that electricity when it's consumed. So what we're going to do here for the next 10 minutes or so is try to get started in your skull the notion of when revenues and expenses are recorded. In chapter 2, we didn't have that issue because it was all balance sheet driven. Here, under the revenue realization principle, 4 criteria must be met. You have done the work. There's persuasion. Come on. Don't worry about these 4 lines here. This is all applied, basically assumed. What we're saying here is revenue is recorded when they occur. Same thing with expenses. So let's see what we have here. Here, we ordered some food from Chipotle from a party, okay? They delivered the food and we paid it right away. So let's see what we have here. If cash is received before the company delivers goods or services, the liability account, unearned revenue. Well, here's what happened. I ordered pizza for the class, where I ordered Chipotle's for the whole class, right? And Chipotle said, okay, Bob, that'll be $1,000, please. You got to pay me now. Well, I paid Chipotle the $1,000, but they haven't earned anything yet. They can't record revenue until they perform the service. They cannot record any revenue until they feed us. So when they got my cash, they debited cash. This is your journal entry. They debited cash and they credited this liability account called unearned revenue. They don't owe me $1,000 in cash. They owe me a couple hundred burritos. So here's an example where the revenue is not recorded at the time of the payment. We're paying before. Here, we paid it in advance. And now on the bottom here, what they're showing you, when they deliver it, then you're going to debit that liability account and credit the revenue on your income statement. Here, it's nice and easy. Here, they delivered the pizza, they delivered the Mexican food, and I handed the guy a check for $1,000 and we're done. Here is an example where the cash and the revenue do occur simultaneously. So that makes it pretty easy. You don't need any adjustment there. This is a very typical situation here. The whole world runs on credit. People are always buying things and paying for them later. I'm talking about companies, right? If cash is received afterwards, well, that's going to be an accounts receivable to one person and the accounts payable to the other. But we're Chipotle. Chipotle delivered the food to me. They delivered the food, and in so doing, they earn the revenue. They earn the revenue. So they can put on their income statement a sale of $1,000. But they don't have any cash yet. They do have an asset, though. They have accounts receivable. That's an asset that will be replaced by a better asset, huh? Maybe the deal is I have to pay them in a month. At that point, when I pay them, they debit cash and they credit accounts receivable. So there's an example where the payment is made after the revenue principle. The revenue principle. Cash to be collected and already earned. Revenue, what are they talking about here? Interest receivable, yeah, interest receivable, interest revenue would be a journal entry, rent receivable, rent revenue. And I guess the only point they're trying to make there is reinforcing that the sale is recorded when the transaction actually takes place. We just went through revenues. Let's go through expenses just as briefly. Here is a super important gap principle, ladies and gentlemen, the matching principle. It requires that costs incurred to generate revenues are recognized in the same period where the costs take place and the expenses. For example, when the Chipotle's restaurants provide food, revenue is earned. We have to make sure that we record the expenses incurred that same period, not in a future month. Otherwise, you'll have a mismatch. You'll have 1 month that is wrong, and then the second month will be wrong in terms of the financial reporting. Matching principle, simply revenues, expenses. What do you match? Revenues, expenses, matching principle. So here we go. Now we're on the other side. Now we're doing the expense side. Well, if cash is paid before, that money that we paid out, that's a prepaid expense. Prepaid expense. We bought an insurance policy for XXX dollars, but that policy goes into play next year. So right now, there's no expense. It is a prepaid asset. Then comes the new year, and we're going to take this number. Let's assume it's $12,000. And we're going to every month take $1,000 of this prepaid expense, and we're going to reduce it and put it into the proper expense. So there's an example of a prepaid expense. Maybe a few of you have kind of noticed that a prepaid expense is the same thing as unearned revenue, depending on what side of the fence you're working. One man's prepaid expense is another woman's unearned revenue. We paid for an insurance policy that doesn't go in effect till next month. So we can't record any expense. When State Farm Insurance got this check in the mail, they debited cash, but they could not record any revenue. They had to put it into unearned revenue. So I think that's a helpful tip, that prepaid expenses are the same thing as unearned revenue, depending on what side of the world you're working. Just like accounts receivable, one person's accounts receivable is another one's payable, perhaps. Okay, here's the matching principle. Well, this one's pretty easy. When the cash is paid on the date the expense is incurred, we just debit the expense, credit cash, no adjusting there. If it's paid afterwards, cash paid after the expense is incurred. Well, this is the same thing we do with the asset side. They delivered the pizza, they delivered the food, and they handed us a bill. Well, they gave us the food, so that's an expense. We haven't paid it yet, but we have to recognize that we owe the money. That expense belongs with the expenses of this month here. It has nothing to do with the cash. When cash is paid, here we go. The payable goes down with a debit, as does cash goes down with a credit. Yeah. They're talking about Bernie Madoff again. Some of these guys are real bums. Bernie Ebbers. As we get into the class, I got wonderful war stories to tell about these guys. Go back to our accounting equation now. Our accounting equation, as you know, is assets equals liabilities plus equity. Revenues and expenses at the end of the month will change the equity. That's part of the closing process. So let's take a look here. At the end of the month, we're going to take the revenues, subtract the expenses. That's going to be your net income. And that net income is going to increase your retained earnings. And let's see. This thing is giving me a little problem here. Okay. Retained earnings, we should know that is an equity account. Increases with a credit, decreases with a debit. Revenues have a normal credit balance. Expenses a debit balance. So any income, anytime the revenues exceed the expenses, we have income, which is going to increase your retained earnings. So let's just look at a couple of transactions here. Chipotle purchased food costing $2,077, and they paid some in cash, and they owe the rest. Okay, so they brought in, meat and soda and ingredients and things. That asset goes up by $2,077. The cash goes down, and they're going to pay their supplier in 30 days. That's a typical transaction that affects the income statement and the balance sheet. Okay. Chipotle paid in advance for rent. Here's the classic prepaid unearned revenue thing. We're the ones who paid for the rent. We paid $36,000 for 6 months rent, and then we paid $32,000 for insurance and $18,000 for advertising. All of them are prepaid. What that means is this insurance, this rent, and this advertising kick in next month, next year, or some other time in the future. At the time we paid these people, it is an asset. It is an asset. So you would see on your balance sheet, you'd probably see 3 different lines. You'd see prepaid rent, prepaid insurance, and prepaid advertising. So our asset goes up and the cash goes down. We swapped one asset for another. And the insurance companies, when they got this money, they debited cash, which is the opposite of us, and they credited unearned revenue. Chipotle sold some food. I hope so. For $619,000, $4,000 was sold to universities on account. You notice they don't give much credit to college or college students, I guess. So what do we have here? They sold food for customers. So much of it was in form of cash and some was credit. The revenue totaled $619,300. They immediately got paid for that. And the difference is $4,000 that the students or whoever are going to pay later. Look at your cash account. It was started at 349.6. It went up by the 615 right here. And then we had the 167. Got a couple more here. They paid $49,000 for training expenses. Okay, that's just a simple normal activity. The expense, they're calling a general and admin expense. That's a broad category, G&A. In your chart of accounts, that would probably be called employee training expense. That went up and the cash went down. And guess what? We have to pay our employees. So they paid employees who worked this quarter, $138,600. And notice they're saying they also paid last quarter for $91,500. What that $91,500 represents, everybody, is the last week of work probably from the prior month. You've all been out in the workforce. When you go home on Friday, your boss doesn't hand you a check that day and pay you right up to that moment you left the building. No, you're going to get paid maybe 2 weeks later, a week later. Same thing here. So they're paying the $138,600 to people who worked during this quarter, plus the last week of the last quarter. That's called an adjusting entry, which we'll get into in chapter 4. So notice your journal entry. And they sold for cash land. Okay. They sold land. Well, this is definitely not an operating item. We know that. They sold land, property, equipment for $11,900 at a loss. Uh-oh, here you got to put your thinking cap on a little bit, huh? They sold land costing $11,900. That's how much they had paid for it, and that's how much they have to take off their books. But they lost $1,300, which means they paid means they only collected $10,600 on the land. That one's a little bit trickier. They sold some land and equipment, property and equipment, and they sold it for $10,600. The land was worth $11,900 on the books. They suffered that loss. People paid bills. Go ahead, Ian.
Question. That would happen just because, like, they bought it for $11,900 and then it lost value before they sold it, or they just sold it and it wasn't a good deal for them or something.
Well, first of all, the $11,900 is what they paid for it. And that 11,900 in will always be what is on their balance sheet, okay?
As an asset.
As an
while
asset,
they have-
as an asset, yeah. So in this case, they decided to get rid of it for whatever reason, even willing to show a $1,300 loss.
Okay.
Does that address your question?
Yes.
Okay. You know, think of it this way: if they had sold it for $15,000, you would see 15,000 here, and then you would see, I guess, $4,100 here as a gain.
Okay.
Customers paid their bills. We love that. Cash went up. Receivables went down. We paid for things. We had to pay for people. We had to pay our suppliers. You know, somebody delivered food to us, handed us a bill to pay later. Cash goes down 37.2, and payables goes down 37.2. And I think we just have a couple more. They incurred and paid. So they're just showing you more expenses. The expenses are building up. Debit these guys. And they're saying they incurred and paid them. So there's no accounts payable issue. Hey, they got some investment income. How nice. Revenues went up with a credit. Cash went up with a debit. And here's a good area. This is an interesting area, and you're going to be assigned a paper to write about this. Chipotle sold gift cards for $15,400. Classic unearned revenue. People go in to Chipotle's and they buy gift cards for, you know, birthdays and stuff. And Chipotle debits cash and they credit unearned revenue. These people may never, ever cash these gift cards in. So it's unearned revenue. And the paper you're going to be asked to write is the new treatment in accounting, where businesses must estimate some of that usage. So here we go. Our cash started at 349.6. These are the same beginning balances we had earlier, I believe. Except now we have the income statement side. So we have income of 619 plus 4, you got 624 minus these is your income statement. Income statement, stockholders' equity, balance sheet. They're done in this order. You must have the net income because you need to roll that into the equity statement. And when you get the new equity, that's going to be the change in your net worth of the company. And this is a good grid here, the way they present this. Do the income statement first, net income. That's an easy one. Statement of equity. It's 4 lines. 4 lines. Beginning retained earnings, whatever the balance was at the end of the prior month, plus this income, minus any dividends, gives you the ending retained earnings. And then we're going to take that retained earnings and move it into the balance sheet with a closing journal entry. Here's their trial balance. Everything balances nicely. And here's their income statement. Income statement. Note the operating income. That's the first thing. An investor would probably look at the operating income first. And they would say, well, let's see, 372 over that. Wow, every time they sell something, they're bringing back another $0.50. Every time they sell something for $1, they're making a profit of another 50 cents. So that looks good. These items below, you can't really control them as investors. The income statement is presented to highlight the structure, but note that it's based on unadjusted balances. Now, you're not supposed to know that yet. And this is the transaction I did in my head a couple of times here. Net profit margin, very basic. The income was $215,000, right? And the sales and the sales were 2,269,500. Yike. 2,269,500. Are they slipping different numbers in on us? I don't care. We're okay. Because what we want to learn here is that the net income divided by the sales, in this case, gives us 9.47%. That means that for every dollar of sales Chipotle records, they come up with an extra 9.5 cents, say 10 cents. So they're earning 9% on their sales. If they took that 2,269,500 and chose not to put it into a business and they put it into a bank today, they would get less than 1%. So to me, that's probably a good profit margin. Cash flows, oh, we're not going to look at that. Okay. So I'm glad you hung in there. Those of you who stayed with me, we went through two obviously crucial chapters, I think. This should set you up in pretty good shape to do the chapter 2 homework and maybe get a start on chapter 3. We're testing on January 30th on chapters 1 through 5. Chapter 5 is very little. It's more of a narrative about the SEC, and it's nothing that's going to be very heavy on the test. Chapter 4 is an important one. Of course, that's the adjusting journal entries. Who's got any questions? Somebody must have a question. Let me see who else is here. Hold on one second. Okay. Okay. Who wants to unmute themselves and motion we end the class?
Seems like we're good to go.
I think we're good to go. You okay, Michelle?
Yeah, I'm good.
What do you think, Christina?
I have a really silly question probably, but could you briefly go over external and internal events just to
Absolutely, absolutely.
clarify that for me, please?
First of all, we have not gotten to internal events yet, but I'll do it. External events are transactions that occur
Mhm.
that include parties outside the company, external. For example, you sell something to another company, that company's external to you,
Right.
okay?
And
You buy something from me, we're two different companies, it's external, okay? You buy insurance, external. Even your employees are external in a way when you're paying them.
oh, okay.
Okay, external. What you're going to learn in chapter 4 is there are internal entries that must be made, and those are called adjusting journal entries. And we're not quite up there yet, but I'll give you one example. You bought a piece of equipment for $200,000, right?
Mhm.
And you're depreciating it at a rate of $5,000 a month.
Okay.
Well, at the end of that month, you have to recognize that depreciation expense. And that's going to be a journal entry to an expense called depreciation expense. And then you're going to reduce the asset by 5,000. That is an entry that's just within the company, internal.
Okay. And
No-
it's
no-
just to like balance
Yeah,
out
and nobody
books and
cares.
stuff.
Okay, good question.
All right. Thanks so much for clarifying that. Appreciate
All
it.
right, Melanie, way to go. Did we hear from Michelle at all? No. No, Michelle. And just give me 1 more second.
Yeah, you heard from me.
Okay, excellent.
I said I was good.
How's Brianna? You're okay, right?
Yes, I'm fine. I just screaming children in the background.
Oh, well, hold on there. And finally, Sean, how you doing? Sean's not reacting. Okay. All right. I guess we can conk out then, okay? Thanks for hanging in there with me.
Thank
And
you
you
so
know
much
where to
for that
find me for tutoring.
That's at 5, correct?
Say what?
The tutoring's at 5 today?
Yeah, I think I start today at 5, right?
Let me double check.
Okay, so I gotta take a long nap before then, huh? I worked, what, an hour and a half today, so I'm a little tired. Okay,
Enjoy your nap. We'll see you at 5, Professor. Thanks so much.
okay, we'll see you later on. Thank you. Bye-bye,
you.
everybody.
Bye-bye.
Bye. Thank you.